restaurant pricing up 12.3% year over year. I thought that was pretty wild.
You're listening to the Ottawa Real Estate Podcast, your go-to source for all things Canadian real estate. And now, here are your hosts, Paul Stevenson and David Warren. Hello and welcome back to the Ottawa Real Estate Podcast, your go-to source for all things Canadian real estate. My name is Paul Stevenson. I'm joined by David Warren. We are both level 2 mortgage agents, and we're here. We're back. Thank you for tuning in. Want to give a quick shout out to our amazing sponsors, Gertin Poirier Avocat Lawyers, Big Insurance in Westboro, Centum, Easy Neon Signs. Go to easyneonsigns.ca and use the promo code TOREP. Get 20% off each and every order. And last but not least, our new sponsor, David, A to Z Cleaning Expert. A2ZCleaningExpert.com. Check them out. David, how are you doing? How are you?
I'm doing well.
Intros are getting long. I feel bad. People are like, hey, get to the show. Let's go.
I know. Yeah, no, it's a long weekend, family day weekend. It was beautiful weather. You know, we had a nice Team Canada men's hockey domination win, I should say.
And the women won their semi yesterday as well.
Yeah.
Women are in the finals
going
against
into
the US,
gold,
which will be good.
Yeah. It was a good weekend of Olympic sports. Yeah. I love throwing on the random stuff on
I know.
on Olympics. Get right into it.
We did that yesterday. We woke up and they had the big air. I think it was the big air women's final and the ski jumping. And you just kind of sit there and it's like something you would obviously never see on TV. And you're just kind of mesmerized by half the absurdity and half the athleticism. Just like, what is happening? And wow, it's like the double. I wanted to say there was actually a few comments last week as well that we could touch on later in the show. But I wanted to say, to anyone listening, questions. If you have questions about mortgages, Dave and I are here. Our contact info is in the description. Actually, I had a few people reach out last week after I mentioned that, so I figured it might be worth reiterating. Like, we are here to help. If you have questions, we're always up for conversation, so please reach out. Dave, last week we started by talking, I don't know if we started, but this week we're going to start with it. We talked about the Nova Scotia 2% down payment and how, different provinces might start getting creative with regards to affordability and so on. I wanted to just follow up on that because some new information came out after we had recorded, and I just don't want, to be misinforming people. So we were talking, for anyone who wasn't listening last week, that Nova Scotia was launching a pilot program, basically allowing first-time buyers to purchase a home with as little as 2% down through participating credit unions. So the province effectively was stepping in to kind of backstop what would normally be covered by insurers, so CMHC and so on. Now, the downside of this, obviously, there's a few downsides, and that's kind of what I want to touch on. There was a few caveats in there that we didn't discuss last week, and I wanted to just kind of make people aware of them. So one of the big ones that I thought was concerning, I guess, if you're a home buyer, is that you're locked in with the credit union until you build at least 20% equity. So you're starting with 2%, and you have to build it up to 20 before you can leave. So what does that mean? That means at renewal, you can't shop around. So it means, when you come up for renewal, that credit union, you're essentially at their mercy because you can't leave until you have that 20%. Credit unions usually do have slightly higher rates as well from the onset. So that can, actually make it more expensive for you. It is only credit unions that offer this program. So it's not available through, Scotia's, TDs, et cetera. You can sell if needed. So even if you don't have the 20% equity, you can sell the home to buy another one using a regular insured mortgage at competitive rates. So that is one bonus. The maximum amortization is 25 years, so you can't get the same 30 years you would with an insured mortgage as a first-time buyer by putting 5% down. Purchase price limits apply, so homes must be under $570,000 in Halifax and under $500,000 everywhere else in Nova Scotia. And also, I think there was a cap on income. I think you had to have less than a $200,000 income, if I'm correct in that. I know you had a few more stats there, but those are kind of the highlights for me that were worth noting, that we didn't touch on last week.
To your point, after kind of that headline news came out, there was a few mortgage blogs and writers that kind of dug into it and spoke to a number of the credit unions in Nova Scotia to kind of get further details. So 3 of the credit unions that were spoken to that are going to be offering it, they're going to be charging 40 to 100 basis points of a rate premium on those 2% downs versus a 5% down. They might not be taking There might not be a premium being charged on that mortgage, but you are paying a 0.4 to a 1% higher rate. They are going to be capped as well on the GDS TDS qualifying. So it's going to be a 35% GDS, 40% TDS versus where people are at right now with a 5% is 39.44. So that's something that's kind of big and to be cognizant of. And then to your point where you're mentioning about a midterm switch, meaning when up for renewal on that 3 year, that 5 year, whatever it may be, if you have less than 20% built up in as far as equity, you will not be able to move that mortgage because you're not going to be an insured mortgage. Where if you have a 5% down mortgage and you want to shift banks to what you were kind of referring to of kind of that movement, because you were never insured with a mortgage insurer, that mortgage cannot be transferred to a TD, to a First National, to a Strive, whatever it may be, RBC. Like, you're stuck with that credit union regardless until that 80% has been built up, and at that point, then you would be able to make any sort of movement. There's also whether they're going to charge an additional admin fee on that or anything, but up front, arguably it is going to help people as first-time homebuyers get into a home that much quicker. Um, they're saving basically when you're factoring in the insurance premiums. The 2% down borrowers save roughly $6,800 up front versus a 5% down mortgage for every 100,000 borrowers. So it takes obviously to offset that, you've got a lot of you have to have a lot of interest savings over that period of time to make that up, because that is a pretty drastic savings. However, if you're fine and you can fit within those parameters, then you're really kind of in good shape. But the Nova Scotia, their latest average home price has been $435,000. So you kind of are falling within those guidelines that they've outlined, of that $570,000 in Halifax, at $500 elsewhere. So it is a kind of that upper limit people are kind of typically going to fall within, but it's just those others, like the qualifying of being stuck on the GDS, TDS, that can really limit people, and the future movement. But really, at the end of the day, for home buyers that are new, first-time home buyers, like, if you fall within those parameters, it's certainly a great avenue to go to. Kind of using that $435,000 average purchase price at 5% down would be $21,769. At 2% down is $8,708. Out of the gate, you're saving $13,061 out of savings. That's a pretty drastic savings. And then the insurance premium on that 5% down, if insuring it with CMHC or Sagen, would be $16,545 versus the 2% down, they have a 0% premium or $0 premium. So that is a pretty drastic savings. So it's not something to be deterred by. I don't think. I think it is a good program for a lot of those people that could qualify. Really, I think the biggest hindrance that people are going to have is just in that GDS, TDS as far as incomes are concerned. But kind of really in it is being able to get into a property with that much in savings and premium savings. I think is a good thing, regardless of whether you having to renew with that bank and kind of taking that risk of being renewed at a higher rate down the line. But that upfront savings, if it means being able to get in now versus in 3 or 5 years anyways, because maybe it takes that long to save that additional 13,000. You will pay down that mortgage. You will have had some appreciation anyways.
Yeah. And I'd be interested to see like multiple case studies of, like someone doing this program and someone doing kind of the standard 5% down, let's say, just to see over the 25 years, like how much interest they're paying based on these numbers, how much they've saved, et cetera. Because to me, it kind of works out in the end to be around the same. It's just a matter of, as you said, like kind of getting into home ownership and kind of building that equity. We talked about this over the last couple episodes, but probably 15 years ago now in Ottawa, in general, you could have a 40-year amortization with a 0% down payment. Now, sounds great. Obviously, you're not putting any money into it, but you're paying an extra, essentially 15 years of interest on that mortgage, right? So yes, you're saving $50,000 up front, but you might be paying $100,000 in those last 15 years or something, right? So like the lenders and the insurers are going to get their money in some capacity. It's just a matter of when you're paying it, how you're paying it, how much you're putting down up front. So I think these programs, we're going to see more and more of them. I think as affordability becomes more of an issue, or if it becomes a further issue as prices continue to grow or as incomes grow, or if the economy gets more challenging, et cetera, like we're going to have to see lenders, insurers, credit unions, they're going to have to keep getting creative like this just to allow people the opportunity to get into the market. Now, do you think this is actually just, I don't want to spend the whole show talking about this, but do you think this is actually helping affordability, or is this just kind of increasing leverage in a softer market in Nova Scotia?
I don't I mean, in my opinion, I don't know that it helps with affordability of home prices because obviously this is a stimulus to the market. So you're going to have then more buyers. So to your point, if there's, a little bit of a supply, it's a buyer's market. This is going to bring in those people that don't have the savings yet. I think what it does allow for is for those first-time home buyers or those renters that didn't think that it would be attainable to save up a down payment of $21,000, that seems like that might be impossible for them, being able to, it's getting them into a home if home ownership is a goal of theirs. And I think that's what it helps with. I think overall it doesn't help with affordability. This is not helping in that regard, but it is with market entry and people not having to be stuck again. If their goal is to own a home, then it is a method for them to get in sooner rather than later or at all.
When I bought my first home, which was in 2011, we put 5% down at the time, and the home was $212,000. And I know I've told this story, but I haven't told in a while. So for any new listeners, you get the experience for the first time. But basically, I bought it for 212, 5% down. I sold it 7 years later for 217,000. So it had only appreciated 5,000, which at the time wasn't that crazy, right? Like the market, we weren't dealing with kind of pandemic 23% increase in values and so on. So, it went up $5,000 over 7 years. But when I sold the property just from principal pay down, there was, 30, 40,000 in equity, which allowed us to get me the down payment for the next property that I bought. You don't have to, again, everyone has a different path. Like for me, it was at 5% and just building the equity. Someone else might be putting in 2%. Maybe they make additional lump sum payments and they build that equity to 20%. Like everyone has a different path through home ownership, but it's just creating opportunities for different people to get into the market, I think is really what we'd like to see. It's just create, like I like seeing these kind of, even if there's going to be pros and cons to every strategy and every structure, but just creative opportunities for people to get into the market where they might not have been able to. I think that's great.
Yeah, no, I agree. This morning, inflation data came out in Canada.
Did it?
And it was actually, it was some pretty good news for the most part. I talked about this last month when we had the inflation data come out and kind of reminding people that a year ago over the Christmas and holidays, we had an HST and GST holiday. It was, we weren't having to pay HST or GST on certain things. And so that is playing into some of the base effects, and they're putting a little bit of upward pressure on prices. And as we started paying taxes on those. So when you're comparing that inflationary data, because sales taxes are inflationary. But what was interesting in these numbers, but even with those, even that played into it, the numbers were actually very good and lower than market expectations. But one thing that was a highlight in it that was pretty shocking to see the figure, but restaurant food is up a staggering 12.3% year over year. Restaurant pricing up 12.3% year over year. I thought that was pretty wild. Well, kind of the headline figures. Headline inflation reading came in at 2.3%, which is lower than last month and lower than market expectation. Core inflation reading decreased as well to 2.6% from 2.8%. And the CPI median decreased month over month, 2.5%, and a CPI trimmed down 2.4%. So all of the readings are within that 1% to 3% target range by the Bank of Canada. There is no decision coming up until March 18th. And the next inflationary data release is March 16th. So right before, we'll kind of see how that plays into things. But yeah, I mean, really kind of overall, it was, it was some pretty good high level numbers from last month. In the base effects from the GST HST break in January of 2025 continued to impact the annual inflation rate to the upside for fruit prices this year, 7.3% versus 6.2%. And that's what lifted the restaurant pricing.
So is that year over year, 12%? Like, is that just
Correct.
saying that?
Correct.
Okay. Yeah. So the GST wouldn't have factored into that other than maybe what they were paying on the food they were buying and then reselling it? Like, is that likely the cause of that?
Yeah, and I mean, well, with that, it was just the inflation on food prices in general. But last year, during that same period, it was at 6.2% on food prices last year because there wasn't that GST HST being paid. Versus this year, it's at 7.3% because we're now having to factor and pay for that GST and HST. So it's driving up that pricing point.
Yeah.
So that kind of plays into that, what the restaurants end, because they obviously have their spread over and above what they're paying, right?
I was going to say, it's just funny when you think about, like, when you look at the percentage of, let's say, 12.5%, it looks so staggering. And then you think, like, if you're at a restaurant and a meal is $22 and now it's $24, like, you're not even really, you're like, oh, it's $2, right? But when you look at it as a percentage, you're like, holy shit, like, what happened? Like, why are we paying so much more? But really, it's an extra dollar or two. But when you multiply that by, X amount of meals out, X amount of restaurants, like, it obviously adds up pretty quickly. So
Yeah. No, absolutely.
even the best photographer can't hide drywall dust and paint splatter. And every day you delay listing could mean missing peak spring pricing in Ottawa. A to Z Cleaning Expert gets your property truly photo ready. Don't risk going to market half ready. Mention TowRep at atozcleaningexpert.com to receive priority scheduling for your next listing. Are you trying to grow your mortgage business? Centum has the tools and support to help you take your business to the next level. Get access to everything from free, unlimited custom marketing to daily direct pay. Find out what your business can do with Centum. Learn more at joincentum.ca. Your home is one of your biggest investments, and the team at Big Westboro can help you protect it. Our expert brokers will find the perfect coverage to keep your home and belongings safe. Call 613-239-5792 or visit thebig.ca/Westboro for a free quote. Think big, protect what matters most. Are you thinking of buying or selling a residential property? Relationships are at the heart of every real estate transaction at Gertin-Poirier Avocat Lawyers. We love to bring residential buyers, sellers, agents, lenders, mortgage brokers, and the law together to close the deal for you for an effortless client experience that opens doors. Call us at 613-744-4488 or visit our website at gertinpoirierlaw.ca. Let's get to the heart of your deal. This episode is brought to you by Easy Neon Signs. Visit easyneonsigns.ca and use the promo code TOREP, TOREP, to get 20% off each and every order. easyneonsigns.ca, Canada's finest custom neon sign maker.
In the figures that I was on the other side, kind of deflationary, was really in the transportation sector. So down 17% versus a negative 0.5% in December. So reason for this is that oil prices kind of plunge. So gasoline prices are down 16.7%. So that obviously plays into transportation costs. Inflation slowed on shelter to 1.7% versus 2.1%. And also, costs, household operations, so costs of, heating and all of that, and furnishings down. So it's at 2.5% versus 3.6% last year. Yeah, I mean, really kind of obviously in the CPI numbers, with oil being down and transportation kind of driving that lower substantially at a negative 17%, obviously helps to play in that, and oil being down kind of helps to bring down a lot of those other costs, whether it be like furnishings, household, like all of that. Obviously, the lower the transportation costs and the lower fuel costs are, obviously there's a lot of industry and a lot of other areas that play off those. So as that comes down, then overall everything will see kind of those prices come down. So what does this mean for mortgage rates? How does that play into it? Well, because of these numbers that have come out, as of today, we're down right now I think we're down 13.5 basis points. And it's the lowest reading on the 5-year bond since November 27th of last year. So that's a good thing. So we'll likely continue, right now we're seeing that downward pressure on fixed mortgage interest rates with them continuing to come down. So we'll see kind of how that plays into when and if lenders really make any movement, or whether they leave it for a period of time to just see how the market reacts. Because a lot of times what they do is they'll wait it out. They'll wait and see. They'll leave that margin in there, and they'll wait to see what others are doing, what the market is doing, and react that way. But they don't change on a daily basis with every lender. Over this week, if everything holds with where the level's at on the bonds, I think we'll start to see probably near the end of the week some rates come down, but to be seen.
Yeah, I agree. And there usually is that lagging effect. Like, it usually takes a few days. But I think, as soon as one lender announces a rate drop, it tends to be a domino effect, right? So it just, we'll wait for that first domino to fall and see what happens. The other thing I think with regards to the deflationary stuff, like, our Canadian dollar has been strengthening as well over the last few months. I'm sure that plays into it as well in that sense, like as far as the cost of oil and so on.
Yeah, absolutely. I mean, for us, obviously, the stronger the dollar is, the better off we are as well in that regard from a buying power, but it hinders our exports.
Right. Last thing I wanted to touch on, Dave, was the CMHC study. So they did a study that finds that regulatory red tape drives up Canadian home prices. Eh? Captain Obvious here, CMHC. So we've talked about this many times, and I'm just happy to see that there is now a study that confirms it. It says, a new CMHC study is pointing the finger squarely at municipal land use regulations as a major driver of housing affordability challenges in Canada. The report suggests that cities with more restrictive development rules tend to have significantly higher home prices and slower housing supply growth. According to the findings, when regulatory restrictiveness increases by 10%, home prices tend to rise by roughly 14%. That's a meaningful correlation. Ontario cities were found to be more restrictive overall compared to Alberta municipalities, and not surprisingly, some of the least affordable markets also ranked among the most regulated. The takeaway is that affordability is not just about interest rates or immigration levels, it's also about how quickly municipalities allow housing to be built. Lengthy approvals, zoning limitations, density restrictions, and development charges all compound into higher final home prices. This reinforces the idea that solving affordability requires structural reform at the municipal level, not just monetary policy shifts. I mean, this is, to me, the most obvious. I think, there was a report, I think, last week that said that of the 500,000 homes that they were planning to build, I think 9 were completed. I know there's a bunch that have started, but I think a lot of that is because of the restrictions, development charges, like all the things that come along with that. How do you feel about this, Dave? I know you felt this firsthand. You've seen it with your clients. Like, does this surprise you in any way, this study?
No, I don't. It's it's outrageous that they probably spent 5 years doing this report as well.
Millions of dollars, sure.
Yeah. No, I mean, obviously, regulatory red tape, how long it takes for anything to pass through to be built, it drives up pricing because we've talked about it in the past. You have to hold, a developer has to hold that property for that much longer. They have to spend that much more money on professionals to fight the city on certain things or to delay, not even to fight them. It just takes it's just such a bottleneck to get past through anything that, that obviously the longer they're having to hold a property before they can start development, it's, it increases pricing. And then you get into other variables that, they're not able to go within a specific period of time, like a shortened, condensed period of time where their budget, they know their numbers, and now it's dragged out in some cases 5 and 10 years. Well, that original cost of what they were going to build has now changed dramatically, with inflation, with pricing of where things are at, the market shifts. And we've seen that in the last couple of years. I mean, if COVID showed us anything, it's that, things can change on a dime, and especially for pricing. I mean, COVID hit, price of, trades skyrocketed, of materials skyrocketed, they've come down. How is a builder supposed to plan accordingly for that? So the longer they're having to hold that project, the riskier it becomes for that project. And they need to factor that into everything.
Yeah, there was actually, I just found this here. It says CMHC housing starts are forecasted at 247,000 for 2026, which is actually down from 259,000 in 2025. It says developers face higher construction costs, weaker demand, and rising inventories of unsold units. There you go. In an alternative scenario, CMHC predicts 480,000 homes sold and an average price of 693 in 2026 housing starts. So yeah, I mean, it seems like 247 for the whole country in 2026. That's starts, so not completions, right? I think there's often confusion with that too. There's always housing starts, but we need homes built, not ground broken, As my house shakes as they build homes to just next door to me here. We're on week 4 here. It's great. It's very fun. Can't wait to get to the office today. Dave, how do you feel about some mood boosts? Are we ready?
Boost me. Boost me, Paul.
I have 3 today. It's a bit late, but I got some Valentine's Day boosts. It's always a good day for love, David. Number 1, which dating app do trees use? Timber. Number 2, stop looking for the perfect match. Use a lighter. Much easier. And number 3, told my wife she should embrace her mistakes. She gave me a big hug. Yeah. There we go. Thank you, everyone. Thank you, everyone, for being here. Thank you for listening. Thank you for supporting the podcast. We'll be back next week, 10 a.m. every Wednesday. New shows released. We want to say thank you to our amazing listeners, yourselves, and our amazing sponsors. Gerté Poirier, Avocat Lawyers, Big Insurance in Westboro, Centum, Easy Neon Signs, and A to Z Cleaning Expert. We'll be back next week, everyone. Have a great week. Keep your eyes out for rates dropping. Here we go. Spring market, baby.